Hi there, this is Simon, personal finance coach. Roth IRA conversion is a powerful strategy to add hundreds of thousands of dollars to your retirement savings by legally minimizing tax burden. In this video, I'm going to address common considerations and tax mistakes to watch out when converting from traditional IRA to Roth IRA. We will cover what is the rule of thumb for conversions, how the conversion may trigger higher Medicare premiums as well as higher Social Security and capital gain taxes, and why you should save money in both Roth IRA and traditional IRA, especially in your younger years. In the interim, please subscribe to this channel to receive notifications on future videos.
Let's begin with defining the difference between traditional IRA and Roth IRA. Traditional IRA and Roth IRA are both types of retirement saving accounts. They both allow you to contribute savings during your working years and withdraw these savings along with any appreciation when you reach certain age. The difference between the two types of accounts is how the contributions and withdrawals are being treated for tax purposes by the IRS. With traditional IRA, you contribute pre-tax money, meaning you contribute before paying taxes on your contributed income, and you pay taxes when you withdraw the money in retirement. These taxes are applied at the ordinary income tax rate. With Roth IRA, you contribute amounts after paying taxes on your income, and you withdraw the money in retirement with zero taxes on the principal along with any gains. Basically, the difference is whether you pay taxes at the time of the conversion or you pay taxes later. A Roth IRA conversion works best under two conditions. Number one, your current tax rate is lower than the future tax rate in retirement. And number two, there is enough time for the Roth IRA funds to grow. If people estimate that they are at a lower tax bracket now than they will be in retirement, they consider converting traditional IRA to Roth IRA and paying taxes upon conversion. To make the conversion estimate, you need to account for taxes, considering your tax bracket and your marginal tax rate. To account for taxes, you need to know how tax brackets work. The U.S. tax system is progressive, meaning income is taxed at different rates depending on how much you make. In 2025, for example, the 12% tax bracket for a married couple filing jointly extends up to $96,950. The next tax bracket following 12% is 22% tax bracket. So if a couple had $75,000 in taxable income and wanted to do a Roth conversion, they could convert up to $21,950 for a total of $96,950 without moving into the 22 tax bracket. This is where the conversion tax rule of thumb comes in. A common rule of thumb is to convert only up to the top of a given tax bracket to avoid pushing yourself into a higher tax bracket. A follow-up rule of thumb is to spread the conversions over multiple years to fill up an existing bracket and avoid being pushed into a higher tax bracket. The intent is to avoid triggering higher tax rates unnecessarily unless there is a compelling reason to do so, such as expecting perhaps much higher tax rate in the future. Let's discuss now how not to trigger higher Medicare costs that may result if you are not careful with the Roth IRA conversion. While managing tax bracket is important, many retirees overlook how Roth IRA conversion impacts Medicare premiums, particularly income-related monthly adjustment amounts called IRMAA. IRMAA is an additional premium surcharge for Medicare Part B and D that applies to individuals with higher incomes. In 2025, if your modified adjusted gross income, MAGI, line 11 on your 1040 tax form, exceeds $212,000 for married couples filing jointly, your Medicare premiums will increase. Since Roth conversions increase your MAGI, they can unintentionally push you over IRMAA threshold, leading to higher Medicare costs. For example, a couple with $100,000 in MAGI who convert $112,001 into Roth IRA might unknowingly push their income over $212,000 IRMAA threshold. This could increase their Medicare Part B premiums by $185 per month for each person, for each spouse, costing $4,440 additional Medicare costs every year. To avoid an unexpected Medicare premium hike, check the IRMAA brackets before converting. If you're close to an IRMAA threshold, consider spreading your Roth conversions over multiple years. Because IRMAA has a 2-year look back, consider doing the conversion at any age up to 2 years before you are going on Medicare. If you are unaware of the impact on the surcharge, you might be converting the wrong amount that may cost you tens of thousands of dollars. When you do a Roth IRA conversion, you have to be also aware of long-term capital gain tax bracket. In 2025, if your total income is below $96,700 for married couple filing jointly, you pay a 0% capital gains tax. That impact on the capital gain tax is only relevant if you have sold assets that qualify for long-term capital gain treatment. If you haven't, there is nothing you have to worry about. Another tax impact that you need to consider is spike in taxes due to Social Security income. As you convert Roth IRA, your provisional income is increasing. This determines how much of your Social Security income is pulled into the tax calculation. Anywhere from 0 to 85% of your Social Security can be taxable based on your provisional income. So in summary, there are 4 potential tax implications to look out for. Number 1, impact on ordinary income taxes. Number 2, impact on IRMAA Medicare surcharge. Number 3, impact on long-term capital gain tax bracket. And number 4, spike in taxes due to Social Security income. The other question that many people face when saving for retirement is if they should contribute to Roth IRA or traditional IRA every year. The simple answer is to contribute to both if you're eligible. Each account offers unique tax benefit. No one really knows what will be the tax brackets in the future, and contributing to both provides diversification in retirement. Here is a common approach for building retirement in both types of accounts. If you are early in your career or expect higher future income, prioritize Roth IRA contributions for tax-free growth. If you are in your peak earning years, a traditional IRA may offer better immediate tax savings. If you are uncertain about future taxes, split your contributions between both accounts to hedge against future tax changes. The bottom line is that Roth IRA conversions can be a valuable tool for long-term tax savings, but they require careful planning. By following the tax rule of thumb to avoid unnecessary bracket jumps and being mindful of Medicare, IRMAA, long-term capital gain, and Social Security thresholds, you can maximize the benefits of Roth conversions while minimizing surprises. Smart planning today can lead to a more tax-efficient and financially secure retirement. Thank you for watching.